So this is not actually a break of structure. This is where we actually have the ideal break of structure. This is just price taking out this swing low, not yet establishing a valid lower low. This is where we have a valid lower low that have been broke. This is not a valid lower low because we do not have inducement created before the break of the structure, and then this return to raid the inducement. So this is actually the inducement, and then price fell, took out this low. So we are expecting to see that since price created this low point, to actually validate this low point, we want to see price push to the upside and raid the inducement. So you can see we have a minor inducement and then we have a major inducement. This is the ideal high point that sponsored this movement, because you can see this pullback is still within this range, this high and this low. So this is a minor inducement. Now price give.
Hello traders, welcome to the 10th episode of the Nexowell Mentorship Program. In this episode, we're going to dive deeply into market structure. You must understand that a key component of institutional market structure is actually liquidity, and your ability to identify liquidity in the market helps solve your interpretation of price and time in the Forex markets. You basically just need to understand this, that price and time are the key components in the Forex market charts, because they form the structure in the charts. The candlesticks are the representation of this price and time in the Forex market charts. They are a graphical representation of price movements within a specific time period, and your ability to be able to interpret their movements helps you identify high probable zones for trade execution. So let's head to the chart to look at how to interpret and identify market structure movements. So you can see here from the chart, what we have is actually a bullish market condition. So you must understand that the movement of the market is actually to take out external range liquidity, return to fill inefficiency, and also to take out internal range liquidity. So you can see here from this bullish market condition, you can see we have price created the high, we have the pullback, and we have price created the low. So you would understand the multiplex nature of price, that price is actually fractal. You see structure in higher time frame, and then you can also see structure in lower time frame. So basically what we can see within this expansive move is actually the minor market structure formed within the expansive leg move. So this minor market structure forms the internal range liquidity. So what we're going to see is that price created this high as an external range liquidity, and then we have the pullback to the downside, price created the low. We have this minor pullback, push of price, minor pullback, push of price, and then you can see that the market took out the external range liquidity. So what you're going to be looking forward to see is the possibility of price also returning to take out an internal range liquidity. Price is going to feel all form of inefficiency within this expansive leg move, and then aim for the internal range liquidity. And this is that liquidity which we would call inducement or the sell side liquidity, with the possibility to actually mitigate any form of price inefficiency within this expansive leg move. So you can actually see that this is actually the high, this is the low, and then this is the entire impulsive leg move to the upside that took out the external range liquidity. For this higher high point to actually be valid, then this higher high point should actually pull back to the downside to take out internal range liquidity, which in this case is actually the sell side liquidity, which we refer to as the inducement. So basically the inducement is actually a price movement that is created before an ideal break in market structure, or actually after a break in market structure. So it's actually dependent on how the traders tends to identify these liquidity zones. So basically you must look forward to see that price will take out external range liquidity. To validate the newly created high, you want to see that high also take out internal range liquidity. This helps you to actually mark out valid structure. So since this high actually took out this internal range liquidity, which is our inducement and also the sell side liquidity, so you can see that now this validates this high point as a higher high, and now price created a higher low because this is actually higher than this low. And then we have the impulsive leg move to the upside that took out this high point. So this is actually how to mark out invalid structure. So let's look at this example, which is actually an invalid market structure. What you can see is price created the high point, and then we have the drop of price to the downside, and then we have price created this low points. So you can see we have the impulsive leg move to the upside, because from this swing low points to this swing high point is actually the impulsive leg move. Let's not consider this particular price movement yet. So we have this low to this high as the impulsive leg move. But then you're going to identify within lower time frame, you're going to have structure within this expansive leg move. So now you can see that price created a pullback before the rate of this external range liquidity. So we have a valid break of structure where we continue to understand how to actually identify valid break in market structure. So you can see now we have price pullback to the downside, and then we have the impulsive leg move to the upside that took out this high points. But what you can see, price created this high points, but this is not a valid high points, because you can see that price did not return to take out internal range liquidity. So this is what mostly happened in the markets. So structure basically in the Forex market is all about liquidity. Price takes out external range liquidity, return to fill inefficiency, and also rate internal range liquidity. So you can see that this newly created high point did not fall to the downside to take out this internal sell side liquidity. So basically we do not really have a new high points. So indirectly, this is trying to tell us that the entire impulsive leg move is from this low to this high point until we see price push back to the downside to take out this liquidity. Then we actually have this high point as a valid higher high point. So price yet have not created a valid high point, because why? We do not have this movement to the downside taking out this sell side liquidity. These inducements have not been raided. This internal range liquidity is still intact. So we want to see actually that, just the way we can see from this example, that a newly created high point will return to the downside to take out internal range liquidity and then push further to the upside. So this is how you want to be identifying valid institutional market structure. Let's check for the example. So now we can actually see that I told us that we actually have price create inducements before a major break in market structure, or we can see the inducement created after a break in market structure. So it depends on actually how the liquidity gets formed in the market. So now what you can see here is actually that we can see that price pushed to the upside. We have this pullback, price pushed to the upside. So price created the inducements. We have this sell side liquidity. Now you can see that price return took out the sell side liquidity. This validates this as a high point. Now we have the low points, price created the low points. So now what you can see is that this low points pushed to the upside and then took out this internal structure. And now price fell to the downside. We have this created another low point, and then price pushed further to the upside, took out this internal swing high points. Price pull back, and then we have this low actually sponsored the move to the upside that took out this external high side liquidity, which is actually the external range liquidity. Now you can see this becomes the major inducement. So basically I want to show us how to actually identify inducement, the major inducement and also the minor inducement, which basically you can refer to as a major internal range liquidity and the minor internal range liquidity that you're looking forward to see price actually rate before continuation to the direction that the market is actually moving. So we can see here we have this as a major inducement. Why? Because this actually sponsored the move to the upside that took out this external range liquidity. So this is our valid low point. This is the entire low point that sponsored this movement. But within this impulsive leg move, you can see we have minor market structure within this impulsive leg move. So to actually identify this structure, you can see down, this impulsive leg move is what we actually have here as this impulsive leg move. So you can see this pullback, we have the pullback. Now we have price push to the upside, which is actually this leg move. And now we have this pullback to the downside that created this low, which is actually identified here. Now we can see the impulsive that took out this internal swing high points. And now we have the pullback and now price push. So you can see this is actually the last swing low point that sponsored the impulsive leg move that took out this buy side liquidity. This is the inducement, because this is actually the last swing point that took out this external range liquidity. So now we'll be looking at the example that shows us the major inducement and also the minor inducements.
So what we can see from this particular leg move is that you can see we have the impulsive leg move. But then price created the sell side liquidity, basically the inducement. That pullback we want to actually identify within the impulsive leg move before the ideal rate of the external range liquidity. So now we can see the pullback, which is actually a minor structure. But also you can also identify that in the higher time frame whereby you're basing your directional bias. So now we can see that now the market created the inducement. So price pullback, price created this high points, returned and then took out the internal range liquidity. This validates this high points because this high point took out internal range liquidity. So the market moves to take out external range liquidity, return to take out internal range liquidity, fill in efficiencies. So when we go to the real-time chart example, you're going to understand this concept. So now we can see price created the low points, price pushed to the upside, took out this internal range high points. And now we see price pulled back, created this low. So what you can vividly see here is actually minor structural movements because this has not actually pushed to the upside to take out this external range liquidity. So now we have price pull back to the downside, created this low points. So what you're going to see is that now this low point pushed to the upside, but then this low point did not actually take out this swing high points and then gave now a pullback. So this is where we have the major inducement because this is now the ideal low point that sponsored the impulsive leg move that took out the external range liquidity. Why? Because what you're going to identify is price pullback, price return without taking out this high point, and then price created this low, and then we now see the impulsive move that took out the external range liquidity. So where you're going to mark out the ideal low point is actually this, because this is just a movement within this price range. This low did not take out this high point, and then we had a pullback. So this is now where you have the minor inducement, because this is not a strong low swing point. This is actually the strong swing point, because this is the low that sponsored the entire impulsive leg move. So now you can actually see the breakdown in this particular image here. What we can see is this is actually the impulsive leg move, which we can identify here. We have the pullback, which is actually this. Now what you can see is that the market pushed to the upside and then pullback, which is actually this movement here, and then you can see the pullback. But then price created this low points, but then this low points did not push sufficiently to the upside to take out this high points, and then we had price pull back, created a new swing low before the break of the external range liquidity, which gave us the break of structure. So basically this is a minor inducement. This is a weak low. This is actually the strong low, because this is just a low within this price range, this high and this low. So this is actually the strong low responsible for the movement to the upside that took out this external range liquidity. So we can now identify this as minor inducements. So we'll have scenarios in the market where the market would actually return to take out the minor inducement and actually possibly just neglect the major inducement. So this is the minor inducement, or we could see price could just further push to the downside and actually read the major inducements. So this is how you actually identify major inducements and the minor inducements. So now this is actually more of how to identify a bullish market structure. So once price gives the impulsive leg move, you are anticipating to see that the pullback will take out an internal range liquidity, which is actually now the inducement. That price movement that was created before an ideal break-in market structure or after the break-in market structure. It depends on how you can interpret that in the market chart, which we're going to look at an example. So now you can see that now we have the pullback to the downside, and now price took out this inducement, which is actually a sell side liquidity. So this validates this high point because this high point took out liquidity. Now we have price created the low point, and then price gave us the impulsive leg move that broke structure, took out the external range liquidity. So now we can see that now price created another high. This is a valid high because this returned to the downside and then took out the internal range liquidity and then mitigated a sponsorship zone within this impulsive leg move. And now you can see we have the push of price to the upside we have breaking structure here. Now, price created this high point. What validates this high point is the fact that this high point returned back and then took out internal range liquidity, which is the inducement. And then you can see price created the low. We have the impulsive move that took out the external range liquidity. Return of price took out internal range liquidity. So this is what you actually want to be seeing in the market. This is simple. This is just the simple means to actually mark out ideal institutional market structure. You want to look at price taking out external range liquidity, returning to fuel inefficiency, and to also take out internal range liquidity. So this is actually a bullish scenario on how to mark out structure. So let's check out the bearish market condition, how you can actually mark out ideal institutional market structure in a bearish market condition. So let's look at this valid structure identification. So now what you can see is that price created the low point here, and then we have the push of price to the upside. Price created this high point. Now we have price push to the downside. So you can see this is actually a minor structure within the impulsive leg move. So price is being drawn to this sell side liquidity, the external range liquidity. So what you're going to see is that price is actually going to create a buy side liquidity. So that when price takes out the sell side liquidity, the newly created low would aim for the buy side liquidity to actually rate the buy side liquidity before we have the continuation to the downside. And basically, you would see that above the buy side liquidity, we're going to actually see a sponsorship candle, the order block, or you're going to identify a fair value gap, or it's going to be within the PD array that you actually need, the premium and discount PD array. So, and then you now see that price would what? Continue in the directional bias. So now you can see that now price took out this buy side liquidity, the inducement. So this validates this as a lower low. And now price created the lower high. And then we have the impulsive move to the downside that took out this external range liquidity. So you can see in the condition where we have an invalid structure. Price created a low, created the high. Now we have the push of price to the downside. Price took out the external range liquidity. So we want to actually see price takes out the internal range liquidity to validate this newly created low as a lower low. Well, now you can see that price pushed to the upside, but then we do not have price returning to actually take out the inducement, the buy side liquidity. Price took out the sell side liquidity. Price did not return to take out the buy side liquidity. Now, this basically is trying to make us understand that this is not yet a valid swing low point. So now, basically, the impulsive leg move is actually from this swing high to this swing low. So until we have the push of price to the upside to rate this buy side liquidity, then we validate this as a lower low point. So this is how you actually want to identify structure. So let's look at the concept of the major and minor inducements also in the bearish market condition. So you can see we have the impulsive leg move, which basically you can identify it in the other diagram here. So price pulled back and then took out the buy side liquidity, which is actually the inducement. So basically this is the entire leg move in a higher time frame. This is what you're going to see. But this is actually the structure within the lower time frame. So this is actually a minor market structure. Price took out the buy side liquidity inducement, and then we have the fall of price to the downside. Price took out the external range liquidity. So what you can see is within the impulsive leg move, we have this minor market structure. Now what we can see is price fell to the downside, took out this low point, price pulled back. Price fell to the downside, took out this low point. Price pullback created this low, and then this low sponsored the impulsive move, the last impulsive move that took out the external range liquidity. So this becomes our major inducement. We'll be looking forward to see that price will return, take out the inducement, and then validate this as a newly created low point, and then price continues to the downside. So we can see what actually validates this as a major inducement is because we can see that price fell, took out structure. Price pullback fell, took out structure. So price pullback. So this is actually minor structure, which we can identify here. The impulsive, the pullback, the impulsive, the pullback, and then the fall that took out the external range liquidity. So this is now where we now actually look at to identify the minor inducements. We have the impulsive leg move, which we can identify here. Price gave us pullback. This is actually minor structure. So in a higher time frame, you're going to see the movement as this. So now price fell to the downside, took out this low. Price pulled back, price fell, but price failed to actually take out this low. Meaning this high point is responsible for the movement to the downside that took out the external range liquidity. So any form of pullback within this swing low and high is actually a minor inducement. So now this is now the minor inducement. So price will target the minor inducement and possibly aim for the major inducement. So that is why you can see condition where you could actually mark out this as the buy side liquidity you're looking forward to see price rate. But then price would also rate this and in extension rate this. So this is actually the major and this is actually the minor. Because you can see that this pullback is within this price range. So you can see we have the pullback, impulsive, pullback, impulsive, but then failed to break this swing low that created this swing high point that took out this internal range liquidity, this inducement within the minor structure. Now price failed to break this. Now we had this pullback. So this is the minor inducement and this is the major inducement. So how then do you properly identify structure within a bearish market condition? So now we can see that the market gave the impulsive leg move. Within the impulsive leg move, price created the inducement, which is the buy side liquidity. So you can see price created this low. The low pushed back and then took out the buy side liquidity. So this validates this low point. And now you can see price fell to the downside, creating the inducement, the buy side liquidity. Now, to validate this as a lower low point, we want to see price return and rate the internal range liquidity, which is now the buy side liquidity or what you can call the inducement. So now we have price created this lower high points. And now we have the impulsive leg move that took out the external range liquidity. So we want to see price pull back to aim for internal range liquidity, fill up inefficiencies. Now we can see price push back, took out the internal buy side liquidity, the inducements. Price created the impulsive leg move, took out the external range liquidity. So we want to see the newly created low, push back and take out internal range liquidity to validate this as a lower low. So you can see how in this case here, price push back to the downside, took out this low, price pushed to the upside, pushed back to the downside, took out this low. Now you can see how price created relatively equal lows and equal highs. Now price pullback. This is actually the ideal swing to consider because you can see that this movement here and this last high point did not push to the downside to take out this swing low point. Yes, we have this movement to cut this relatively equal high, but this is actually the valid buy side liquidity, the inducement that the market will be aiming to actually rate. And now we can see the pullback took out the inducement, which is the buy side liquidity, fell to the downside, took out the sell side liquidity, which is now our external range liquidity. So basically, this is just how to identify structure. We're going to look at real-time chart example so that you can actually see this. So we can see the market gave the impulsive leg move, created the high pulled back, took out the internal range liquidity, validated this as a high point. Now we have price push, give us a new high. This pushback took out internal range liquidity. This is a valid high point. Price push took out the external range. Return took out the internal range. This validated this as a higher high. Price push took out the external range liquidity. We have a valid higher low. Price came to the downside, took out the internal range liquidity. So you can see this was created before the break of structure. This was created after the break of structure. So it depends how you actually identify the liquidity in the real-time charts. So now what we can see is that price gave us this last impulsive leg move that took out this external range liquidity. Now you can see price fell to the downside. So in a scenario where we have that price actually closed below the inducements, the candle body closed below the inducement, we can see the tendency of price giving us a reversal. So price can take out the inducement with a candle body close below the inducement. Or we can just see price will push to the downside, just weak it and then continue to the upside. So we are going to check that in real-time chart example. So in this case now, we can see that price pushed to the downside, and we want to take this as the market actually closed below this swing low points. So you can see we can identify this as a minor market structure shift. Until we see price takes out the major low point, we do not have a major market structure shift. So price could close below the inducement and still continue to the upside. But now in this example, you can see price closed below and then created this movement to the upside, but failed to continue and take out the external range liquidity. And then we have price further fell to the downside. Now price created this inducement, price went to the upside, took out this inducement and still fell to the downside. Now we have this pullback and then price fell, took out the major swing low points. So we have a major market structure shift. What we're going to see is that now the market would actually return and take out this internal range liquidity that sponsored the move that took out the external range liquidity to actually validate this as a swing low point. And then we have the impulsive leg move to the downside that took out the external range liquidity. Price pullback took out internal range liquidity, and we have the fall that took out the external range liquidity. Pullback took out internal range liquidity to validate this as a lower low. So this is how you actually identify structure. So in the case where you see the market reacting like this, market not creating a new high point to take out the external liquidity, can actually take a sell entry and target an institutional or sponsorship candle at the swing low, because the possibility might be that price will just mitigate the order block and then push to the upside. Until you see price takes out this swing low, you do not have a major shift in market structure. So how do we identify an ideal break of structure? You want to actually see the candle body close above or below the swing low, the previous swing low, depending on the market condition. So now you can see here we have a bearish market condition. So now what we're going to see here, we do not have a valid break of structure here. Why? Because this candle body did not close below this candle wick. And the next candle body also did not close below this candle wick. So in this case, we do not really have a valid break of structure. We really have what? A sweep on this sell side liquidity. So now let's look at this condition that is actually bullish. We have price give us this movement to the upside. We have this bearish movement, and then price created the impulsive movement that took out this high. We do not have a valid break of structure from this particular candle, because you can see the candle body did not close above this swing high point. Neither this candle body closing above this candle high points. So we do not have a valid break of structure. So what actually qualifies and identifies this swing high as a valid broken swing high is actually this candle that closed above this previous candle. So this candle is what validates this swing high as a broken swing high. So in the case where the market takes out this swing high with a wick, we do not have a valid break of structure until we see that the next candle body close above the previous candle high and also the swing high. Then we actually have a valid break of structure. So you can see now that the break of structure is actually transferred to this candle. This candle actually validates the break of this swing high points. So let's further check this example. So now you can see we have this pullback, price fell to the downside. So you can see here we have a valid break of structure because we have this candle body closed below this swing low points. Now we have this pullback, price fell to the downside. What you can see here is a candle wick that took out this low. So we only have a sweep on this sell side liquidity. We have a sweep on sell side liquidity here. We do not have a break of structure until we see that a candle gets formed that close below this candle low point. Then we have a valid break of this swing low. Now price gave us the pullback and then price fell to the downside. So this is the candle that validates the break of this swing low points. So this is where we have the ideal break of structure. This candle did not actually break this swing low. This candle actually swept the liquidity resting at this swing low points. So this is actually the candle that validates this swing low as a broken swing low. So we're going to look at real-time chart examples so that you can actually identify how to mark out ideal institutional market structure and actually how to identify valid break of structure. So guys, we're going to look at this real-time chart example on how to actually identify ideal institutional market structure. For you to actually master this art, you would really need to backtest your chart after this episode. Go back to the chart and then look at what you've learned and then try to apply them in the chart, see them through the charts, and then mark out structure for yourself. By doing this, you'll be able to master how to identify ideal institutional market structure. In coming episode, we're going to look at real-time chart replay so that we can mark the structure as price is being delivered. But for now, we're going to stay with this established market structure, and I'm going to explain it to you guys so that you will understand the ideology behind price delivery. So now what we can see is that we have this impulsive leg move to the downside. And what we can see, we have this pullback to the upside. Price created the inducement before this fall. What you can see is price created the swing low. Price aimed for the inducement, which is the buy side liquidity. Because we can see slightly above this high point, we have the fair value gap. So the reason that we have this fair value gap would actually make price be attracted to this fair value gap. So price, you can see, raided the buy side liquidity, which is the inducements. So you can see that this corrective leg move took out this swing high point, and then we have the impulsive leg move to the downside that took out this low point. So this is a valid low point, and this is a valid break of structure because you can see this candle body closed below this swing low. This is a valid low because this took out buy side liquidity, mitigated the fair value gap. Then we have the impulsive drop to the downside. Now what we're going to see is that we have the pullback of price to the upside, and then price fell to the downside. So this is actually our major inducements, because what you're going to see is that price fell to the downside. This is the pullback leg move after the break of structure. We do not have a pullback leg move before the break of structure. We have that after the break of structure. So once price created this low, price pulled back, price dropped, price did not break this swing low. What we can see is that now price created another pullback within this range, this high and this low. So you can now see this is a minor inducement, because what you're going to see is that this is actually the ideal high point that sponsored this movement to the downside that took out this low point. So this is not actually a break of structure. This is where we actually have the ideal break of structure. This is just price taking out this swing low, not yet establishing a valid lower low. This is where we have a valid lower low that have been broken. This is not a valid lower low because we do not have inducement created before the break of the structure, and then this return to raid the inducements. So this is actually the inducement, and then price fell, took out this low. So we are expecting to see that since price created this low points, to actually validate this low point, we want to see price push to the upside and raid the inducements. So you can see we have a minor inducement and then we have a major inducement. This is the ideal high points that sponsored this movement, because you can see this pullback is still within this range, this high and this low. So this is a minor inducement. Now price gave us this low. This is a valid low because you can see price sponsored the movement and then took out the minor inducement and took out the major inducement. How we can see that price took out the major inducement is because we can see there's still valid fair value gap above this major inducement. And you can see that the major inducement gave us relatively equal high points. So now you can see price took out the minor inducements, returned to the downside, failed to break this swing low. Price pushed further to the upside and then took out the major inducements. So what you're going to see that since price did not create an inducement before this break of structure, you're going to see that price pulled back into inefficiency in confluence with a premium or equilibrium price level. So we can see that price pulled back to the 50%, and you can see we have this fair value gap within that equilibrium level. Price filled the fair value gap, fall to the downside. Now you can see that now when we expand this to the newly created low points that price created, now you can see price pull back into premium price level. And we have inefficiency there. And then price took out the major inducement and fell to the downside. So due to the valid price inefficiency, we have the fair value gap. We can see that now price further push to take out the major inducements. So in a bearish market condition, you'll be looking to sell from a premium price level. So now we can see that now price took out the major inducement, and then we have the fall of price to the downside. And here we have a break of structure. So this is a valid lower low because this took out minor inducement, took out major inducements. So now we have price created the high, we have the drop of price to the downside, price broke structure to the downside. This is a valid break of structure because we can see candle body close below this swing low. Now we can see that before price took out this swing low, price created this pullback. This is a valid pullback because you can see that this is the lowest candle price created. Price pullback, took out this candle high points, took out this candle high points, took out this candle high points, mitigated this fair value gap, and then fell. So we have these as our major inducements because we can see we have a range this high to this low. This is a minor inducement because it is within this high and this low, even though this high point sponsored the movement to the downside that took out this low. So this is not a break of structure. This is where we actually have our break of structure because this is the valid lower low points. So we are looking forward to see that price will pull back and take out the minor inducement and possibly also the major inducement for price to mitigate this other block. But then what we can see is that now price created a new low point, price pull back to cut this inducement. So what you're going to see is that the minor inducement pushed price to the downside, took out this low. Price now created another pullback and fell to the downside, took out the low price created, creating a new low point. Now, this is the lower low that sponsored the movement to the upside that took out this newly created inducement. So you can see how the inducement was transferred. We have the major, the minor, price created a new inducement. Now price took out the newly created inducement, neglected the minor inducement. And now we can see that price fell to the downside. So this is a valid low point because why? This took out buy side liquidity, took out the inducement. Now we have the fall of price to the downside, and then we have a break of structure. But this is not the candle that validates this break of structure. This is actually the candle that validates this break of structure because you can see this candle body close below this candle low and also the swing low. So that is why you can see I'm indicating that this candle actually validates this break of structure. So meaning this is the entire impulsive leg move to the downside. And now we have the pullback. Price to cut this high point. So we have the pullback to the upside. Now we can see this is now the inducement price created, and then we have the fall of price to the downside. So this is now our valid low points. This is not a low point because this candle did not close below the swing low. This is the candle that sponsored the ideal break of the structure. So this is not a pullback to consider as the inducement, because this is actually the candle that validates this break of structure. This candle body did not close below the swing low. So this is now our pullback as the inducement. Price created the low. Now we can see that price pushed to the upside and then took out the inducement. Now you can see when price took out the inducement, reacting at this fair value, that we can see price fell a little. But what we are going to see, the market will do whatever the market wants to do. We have an unrated minor inducement. So what you're going to see is that now price aimed for the minor inducement. So price took out this minor inducement before falling to the downside. So the market would actually do whatever the market wants to do. So meaning now we have this as the entire impulsive leg move from this swing high to this low point. So this is the entire impulsive leg move. And then this is now the pullback. Since this actually took out this lower high points. So we have these now as the lower high. That is why you can see I used a different color to identify these high points. So the market will do whatever it wants to do. The market took out this ideal inducement, but then price in for this other buy side liquidity that was not rated, the minor inducement that was created after the break of this low point. So now you can see price took out this buy side liquidity, the minor inducement took out this ideal inducement that was created after the break of this structure. Now you can see we have the fall of price to the downside. So this is a valid lower low because it took out buy side liquidity, took out inducements. So I told you the market will actually aim for external range liquidity, return to take out internal range liquidity, fill up what's inefficiency. Now you can see we have the fall of price to the downside. We have price created this pullback. We have the inducements. Price further fell. Price created this pullback. This is the inducement. Price fell. Now we have the break of structure. So this is a valid break of structure because you can see we have this candle body closing below this swing low. So the first inducement was created here because this is the first pullback before the impulsive move. But then price did not break the swing low. Price created another pullback. So we have a transfer of inducement from this swing high to this swing high. So don't forget, this is actually the impulsive leg move. So when you go to a higher time frame like the daily time frame, what you're going to see is the impulsive move to the downside. So now what we're going to see, we have transfer of inducement from this high to this high. Now price fell, broke the structure. Now we have another pullback here. So you can see now we have this pullback to the upside. Price created this inducement and price fell, took out this low. This is not where we actually identify and establish our break of structure. This is our valid break of structure because this is not a valid low point. We don't have a push of price to the upside that took out these inducements. So price fell to the downside. Price created this low. So this is where we have a valid low because this sponsored the movement to the upside that took out the inducements. Price created the lower high. And now we have the fall of price to the downside. We have a valid break of structure here because we can see that this candle body closed below the swing low. So basically, you can see that we have this impulsive leg move from this high to this low, and this is the pullback. These are not structures to be considered. These are just minor structures. This is the entire impulsive leg move from this high to this low, and this is the pullback. So understanding the market will take out internal range liquidity helps you to understand when a market actually is in a reversal condition. If you don't understand that the market will take out internal range liquidity, you would consider the break of this high as a reversal, which is actually wrong. So now you can see price fell, took out the swing low. Now we have, this is the pullback after price took out the swing low. We do not have a pullback before the read of this swing low. We have pullback created after price took out the swing low. So we can see price returned, feel this inefficiency, reacted at this order flow, and we can see price fell. This is our inducement. Now price fell to the downside. This is not where we actually have the ideal break of structure because this low is not a valid low. There is no inducement created here where price actually returned to read the inducement, the buy side liquidity. Price fell to the downside. Now price gave us this pullback. Price fell again to the downside. So we have the inducement was transferred from this high to this high. Now we have the fall. This is not a valid low because this did not push to the upside to raid the buy side liquidity before falling so that we can validate this as the ideal lower low. This is still our lower low, meaning this is just the impulsive leg move price is created. So now we can see that now price broke this. We have pullback. This is our inducement. Price fell. Now this is our valid low because this also the move to the upside that took out this buy side liquidity, took out the inducement, reacted at this fair value gap before the fall to the downside. So meaning this is actually our impulsive leg move from this high to this low, and this is the valid pullback. Now we have price fell to the downside, took out this swing low points. So what you can see is that price created the inducement. This is actually the inducement because you can see this is the last sell move and price pulled back, took out the high points. So when we treat valid institutional pullback, you're going to understand how to identify valid institutional pullback. So price took out this candle high, and then we can see this as the inducement. So meaning this is the 4, the pullback, the 4. So price is going to aim to actually take out the inducement. So that is why you can see when price return fueled this inefficiency, price further went for the inducement, the buy side liquidity, and you can see reaction. Price fell, but then we still have price continue to the upside, and then here we have a bullish market structure shift. So even if we cannot establish that this is actually a valid bullish market structure shift, since we do not have this candle closing above this swing high, neither any of this candle closing above this highest candle, we can still establish that we have a bullish market structure shift, because this is an already established market condition we are actually using to make you guys understand how to identify ideal institutional market structure. So what you can see is that now we have the bullish market structure shift. Now what you're going to see is this is the impulsive leg move. So we want to identify the inducement within this leg that price took out, and then we have the continuation. So we establish this as the bullish market structure shift because we can see price created this high, and this high failed to continue to the downside to take out this low, and then we have price reversal. So now what you're going to see is that we have this push of price to the upside. This is a valid pullback. Why? Because what you're going to see is that this candle took out this bullish candle low points. The wick took out the low. So we have the pullback. Price gave us the impulsive leg. This is the entire impulsive leg. Why? Because we have the pullback. Price gave us this movement to the upside. What you're going to see is price created this bullish candle, but this is not a valid pullback because the pullback did not take out this bullish candle low points. Price continued to the upside. So our range is within this bullish candle. The pullback we are expecting is to see any pullback that will take out this bullish candle low points because it is actually the highest candle. But this is just an inside movement within the bullish candle. So this is not a valid pullback. So that is why you can see this is our entire impulsive move, and then we have the pullback because you can see this is the highest candle that price created, and then you can see that this candle went to the downside, took out this candle low points, and then we have this impulsive leg move to the upside. So now you can see now this is our inducement. Price returned and then took out the inducement. Now we have price created a low points. Price gave us a high, created a low. So we are now expecting to see further bullish push of price to the upside, since this high point did not push to the downside to raid this low point. So now we can see that now price gave us this impulsive move that took out the external buy side liquidity. So we want to actually identify the inducement, the sell side liquidity for price to actually raid, and then we have the next impulsive move that will take out this high points. So price created this high. So we're going to look into the impulsive leg move to actually identify our inducement. So what you're going to see is price give us this push to the upside. We have the pullback. Price give us this push. Some will actually consider this as pullback, but this is not actually a valid pullback. Where's the highest candle stick that the market actually created? You can see this is the highest candle. So, and you can see that this movement is within the range of this candle. So we do not have a valid pullback. So we have movement that returns to the downside and take the low of this candle. So this is our impulsive move, the pullback, and then the impulsive move. So you can see this is where the pullback was established. Let's actually mark that out. You can see this is our impulsive move. This is the pullback, and then this is the impulsive move. Because this pullback is within this candle range. So it is not a valid pullback. So now this is where we have our pullback. And now what you're going to see is that the market returned and then took out this, because this swing low is our inducement. This is the pullback that was created before the break of the structure. So this is our inducement, and you can see the market returned and took out this sell side liquidity. And now we can see that now price created the impulsive move to the upside. Now what you're going to see is that now price came to the downside, took out the inducement, price pushed to the upside, but we do not have this movement reading this external range liquidity, price fell. So this is our ideal higher low points. So we can see that now price pushed to the upside and took out the external range liquidity. We have a valid break of structure. We have a valid higher high points because this took out what's sell side liquidity, the inducement. So this is a valid higher high point. So meaning this is a valid break of structure since this is a valid higher high points. So now we can see that now within this leg move, we have a push of price to the upside. This is not a pullback because you can see that this movement is within this bullish candle. So it is an inside movement within this bullish candle. Price did not raid the low of this candle. Rather, this is where we can consider a pullback because we can see this candle return to the downside and swept the low of this bearish candle. So now we have price broke the external range liquidity, broke structure, price pulled back. This is the highest candle that was created. Now you can see price return. This candle took out the low of this bearish candle. And then we have price again pushed to the upside and took out the high of the candle. So this is a valid pullback. So meaning this is our inducement. And you can see that price returned to the downside, took out the inducement. We have a valid higher high. Now price created a higher low point. And we can see that now price pushed to the upside. We have break of structure. So now we can see that now where's the pullback? After the break of structure, this is the pullback. This is not our valid higher high points because this did not return to take inducements created. So this becomes inducement because price pullback and then pushed to the upside. So this created a new high point. So we're expecting to see that this pullback will fall, raid this inducement so that we can validate this as a higher high points. But then price did not raid this. Price further pushed to the upside, took out this high. This is not a valid break of structure because this is not our ideal structure high points. This is our ideal structure high points. So now we can see that now price created this high. And now this high returned to the downside, took out the inducements. Price further pushed to the downside because you can see all form of inefficiency here have actually been mitigated by this movement. So definitely price is actually going to raid this sell side liquidity and this sell side liquidity because we have inefficiency resting here. Price took out external range liquidity, return to take internal range liquidity, fill up inefficiency. And you can see price return filled up the inefficiency and we have the impulsive move to the upside. So this is how you actually identify ideal institutional market structure. So in the coming episode, we're going to have chart replay and then we'll be identifying this as we play the charts so that you can actually see it from a real-time display of price movements. So this is an already established market structure that I'm using so that you can actually understand the concept behind identifying ideal institutional market structure. Till I see you guys in the next episode. Cheers and